Welcome to the CFO's Edge, the podcast dedicated to equipping financial leaders with the insights and strategies to thrive in today's complex business landscape. I'm your host, Eric Weis. Today, we're tackling an area that constantly pressures corporate expenses: Sarbanes-Oxley SOX compliance costs. We call it the SOX Tax, the significant spend on internal staff time, external consultants, and audit fees. As a CFO, your mandate is simple: maintain absolute compliance while dramatically reducing the cost of achieving it. This isn't about cutting corners, it's about optimizing the process. We'll focus on 4 practical, non-software dependent pillars you can implement immediately to drive significant savings. This webinar is part of a series of articles and webinars for financial executives. I've been fortunate to work with hundreds of CFOs to help address best practices and controls. Let me know if you have a topic of interest, and of course, I would welcome the opportunity to work with you. Please do connect with me on LinkedIn and reach out at eric.weiss@SingerLewak.com. Optimize scoping and risk assessment. The single biggest cost driver in SOX is overscoping, testing too many accounts, too many locations, and too many controls. Actionable strategy 1: aggressive scoping reduction. First, drill down to materiality. Do not accept a blanket list of in-scope processes. Challenge your internal audit team to justify every single significant account and disclosure. Focus only on those accounts where an error could lead to a material misstatement. If a balance has 0 movement or is consistently immaterial, justify removing it. Second, perform location rationalization. Review your global footprint. Can you justify not scoping a location if its total transactional volume is below the materiality threshold? Document the risk-based rationale for excluding locations that don't host significant accounts or specialized IT systems. Third, evaluate system and application inventory. Treat financial systems like assets. For each in-scope system, ERP, payroll, treasury, etc., have a documented rationale for why it's a key financial reporting application. If a system only feeds non-material data, remove it from IT general control scope. Actionable strategy 2: focus on inherent risk. Perform risk-adjusted testing. Do not test every control with the same rigor. High-risk manual controls, such as complex journal entries, require frequent, higher sample testing. Low-risk, preventative, and stable controls, like access controls that haven't changed, can move to an annual or even biennial testing cycle. The risk profile must directly dictate the testing effort. Streamline the control environment. Your control environment is likely bloated. Controls accumulate over time in response to findings, but are rarely removed once the risk is mitigated. This creates control redundancy, 2 or more controls doing the job of 1. Actionable strategy 3: controls rationalization. Activate the control for control swap. Task your internal audit function with an immediate deep dive review to eliminate redundant controls. Look for overlapping controls across different processes or systems that cover the same material risk, such as reviewing 2 separate reports to check the same account balance. Rationalize them into a single, more efficient control. Then, shift from detective to preventative. Detective controls, like monthly bank reconciliations, require significant manual effort and post-fact remediation. Prioritize implementing preventative controls, for example, system-enforced segregation of duties or hard-coded transaction limits, within your existing ERP and business systems. Preventative controls are inherently more efficient and require less sample-based testing. Lastly, simplify your control language. Review all control narratives. Are they clear, concise, and focused on the risk? Overly complex or vague control descriptions lead to inconsistent execution and over-testing by auditors. Mandate simple, unambiguous documentation to reduce ambiguity and speed up walkthroughs. Actionable strategy 4: optimize IT general controls. First, standardize change management. Change management is a frequent area of failure. Standardize and enforce a single global process for all IT changes to financial systems. If every department or region has a different process, you increase testing scope. Centralize the documentation and evidence collection for a single point audit. Move to system-based evidence. Move away from manual evidence collection such as email chains and printed sign-offs. The control should be the evidence. For example, an access review should be executed and documented entirely within the user access management tool, not through a separate spreadsheet. Maximize audit and resource efficiency. The key to reducing external audit fees is being 100% prepared. Every hour your external auditor spends chasing documentation or retesting a weak control is an hour you pay for. Actionable strategy 5. Maximize internal audit and co-sourcing reliance. Look to achieve full reliance on internal audit. This is key. Your goal should be to convince the external auditor to rely entirely on your internal audit team's testing for SOX, Section 404. This requires your internal audit function to demonstrate competency, independence, and objectivity. Ensure you have a well-trained SOX provider and methodology who work well with your external auditors to ensure your team's work product is immediately auditable. Commit to strategic use of co-sourcing. Instead of hiring a large, permanent internal SOX team, use co-sourced consultants for this high-volume, repetitive work, and specialized ITGC testing. This provides flexibility and specialized expertise without the full-time salary and benefit costs. Actionable strategy 6, the no surprises audit. Proactive auditor communication is essential. Hold formal quarterly check-ins with your external audit engagement partner to share the internal audit plan, update them on the risk assessment, and review preliminary findings. Surprises lead to scope creep and inflated fees. Organize pre-packaged evidence. Implement a single centralized repository for all control evidence. When an auditor asks for documentation, the control owner should simply provide a link to the complete pre-organized evidence package. Eliminate the chase time for both your internal staff and the external firm. Actionable strategy 7, right-size remediation. A focused remediation response is risk-based. When a deficiency is found, the remediation effort must be proportionate to the risk. For a significant deficiency, a major system overhaul might be justified. For a minor control failure, a simple process clarification and retraining might suffice. Avoid over-remediating minor issues that do not pose a material risk. Cultivate a culture of continuous compliance. SOX is often viewed as a once-a-year event, leading to a costly rush to compliance. A continuous monitoring culture smooths out the workload and dramatically cuts year-end costs. Actionable strategy 8, embedded control, ownership, and training. Hold process owners accountable. Clearly define and enforce that control. Execution is an operational responsibility, not an audit responsibility. The process owner owns the control, the execution, and the evidence. Provide targeted training. Move away from generic annual SOX training. Provide role-specific targeted training to control owners focused only on the few controls they own. Regular short refreshers are more effective than long general sessions. Actionable strategy 9, quarterly attestations. Perform mid-year management check-ins. Implement a quarterly management sub-certification process. Require process owners to formally attest to the design and operating effectiveness of their key controls every quarter. This forces continuous vigilance, helps flag issues early, and provides documented evidence of management oversight that satisfies auditors. Selecting a SOX provider. Partnering, not competing with your Big Four auditor. A critical decision for any CFO is selecting a SOX compliance provider. This isn't just about finding someone to help with documentation. It's about finding a partner who complements rather than competes with your future Big Four external auditor. Remember, your external auditor, the Big Four firm you choose for your integrated audit, cannot perform internal control design or implementation services for you due to auditor independence rules. They audit your controls, they don't build them. Therefore, your SOX compliance provider should be a firm that understands auditor independence. They should be acutely aware of PCAOB rules and ensure their services do not create independence impairments for your external auditor. This means no scope overlap where they're doing what your auditor will later audit. Specializes in SOX readiness. Look for firms with deep expertise in helping companies define public company SOX requirements, not just ongoing compliance. They should have experience building control frameworks from the ground up. Emphasizes documentation and knowledge transfer. A good partner will help you build your internal capabilities by providing clear documentation, training your team, and implementing processes you can sustain. Has strong project management skills, your provider should be able to manage the scope, timeline, and resources effectively. They should be collaborative, not prescriptive. This is a very common problem that leads to a bloated, costly, and generic control environment that may not even address your unique risks. Your partners should work with your finance and IT teams, understanding your specific business rather than imposing a generic, one-size-fits-all solution. Avoids direct competition with audit services. Many SOX compliance firms are smaller, specialized consultancies, or the advisory arms of regional accounting firms. These often have a clear understanding of how to work alongside a Big Four auditor without stepping on their toes. Avoid choosing a firm that also offers external public company audit services that could potentially conflict. Your SOX provider is an investment in your company's future. Choose wisely to ensure a smooth, compliant journey and to build the confidence that your board demands. In summary, reducing the SOX tax boils down to a strategic, risk-based approach, not a technological one. Your key directives are reduce scope, be ruthless on materiality and location rationalization, rationalize controls, cut the bloat and swap detective controls for efficient preventative ones, drive efficiency, maximize internal audit reliance and eliminate the auditor chase with prepackaged evidence. These steps, implemented with discipline, will transition SOX compliance from an expensive, painful event to an efficient, low-cost operational rhythm. If you found yourself nodding along today, you're already ahead of the curve. Our next step for you is simple. We are offering a free 30-minute one-on-one scoping call with one of our lead SOX partners. We will quickly determine your SOX requirements and give you a realistic estimate of the time and resources required for your unique environment. Reach out to me at the email listed here to book your free scoping session. That's all for this episode of The CFO's Edge. Thank you for tuning in.